If you are trading based on supply and demand, you are trading directly against me. Let that statement sink into your bloodstream for a few seconds. Do not rush to defend yourself. Do not pull out colorful charts or a few $100 online certificates to justify your decisions. Open your eyes and look straight into the brutal reality of this business. When you place a buy order at a demand zone you believe is perfect, who is selling to you? Do you think it is some inexperienced trader sitting in a bedroom with an old laptop predicting trends with blind faith? No. The far more likely answer is that it is me. It is our algorithms. It is the institutions with enough capital to rewrite an entire weekly candle in minutes. And the only reason we sell to you at the exact point you call a golden buy zone is because we need your liquidity. We need your blood in the water so we can drive price lower, wipe out your account, and only then allow the market to move in the direction it was always meant to go. Welcome to Wall Street, where the innocence of retail traders is the raw fuel that powers this massive profit-generating machine. Have you ever wondered why 90% of traders fail? It is not a coincidence. It is not a lack of luck. It is a design. A silent, sophisticated design built from the very concepts you were taught. Look back at your charts. What do you see? Clean, square order blocks? Textbook support and resistance lines drawn with ruler precision? You were taught that when price returns to an order block, you enter. You see a reversal candle. You feel confident. You place a limit order. And then, boom. Price slices through your trusted zone like a hot knife through butter, tags your stop loss by a single pip, and instantly reverses to run straight toward your predicted direction. You call it unlucky. Wall Street calls it liquidity engineering. The order blocks you picked up from YouTube or public Forex groups have become common knowledge. And in financial markets, anything common becomes a killing field. When everyone looks at a zone and says, "This is a buy area," smart money does not see a buy area. They see a liquidity pool, a cluster of stop-loss orders resting quietly underneath, waiting to be harvested before real market movement begins. Let me make one thing very clear. We, sharks, funds, market makers, do not trade like you. If you want to buy one lot of EURUSD, you press a button. But if we want to buy 100,000 lots, if we smash the button recklessly, the market explodes. Price slips violently. Profit evaporates. We would be shooting ourselves in the foot. We need sellers. And where do we find them? In you. When you place a stop loss beneath support, thinking it is the safest place, we see a treasure chest. Your stop loss is a sell market order. When it triggers, you panic sell. And we stand there, cold and patient, absorbing every unit you are forced to dump. Your order block, your confidence, becomes our lunch. This is not arrogance. This is the nature of a zero-sum game. Money does not appear out of thin air. It flows from the pockets of the uninformed into the pockets of those who understand the rules. From traders using public textbook methods to traders reading liquidity. Your biggest mistake is treating an order block like a fixed barrier. You think that at price level 1.12345, there is an invisible concrete wall protecting you. But a real order block, the footprint of smart money, is not a passive barrier. It is a scar. It is the crime scene of a massacre where smart money injected capital, wiped out the opposing side, and then drove price the other way. So how do you distinguish a real order block from bait meant for the crowd? This is where you must abandon the prey mindset and adopt the mind of a predator. Retail asks, where will price go? Market makers ask, where is the money? The money sits inside stop-loss orders. The money sits in the places where the crowd feels the safest. When you see a perfect double top and call it a bearish reversal signal, I see a pile of buy stop orders sitting above it, waiting to be collected. Before the market drops, my job is to break through those two highs, take every drop of liquidity, and only then allow price to fall. That is why the order blocks you draw mechanically are meaningless. They are merely rest stops where price gathers momentum before crushing you. You try to catch a falling knife with bare hands, while we wait for the knife to hit the floor, shake a little, and then pick it up. The difference between retail and professionals does not lie in how many patterns you know. It lies in your ability to filter noise. The market is a noise machine. Indicators, news, and false signals flood the screen. If you trade every order block you see, your account will bleed out through a 1,000 small wounds. You need a filter, a lens that cuts through the fog, a system that tells you which zones smart money will defend and which ones are nothing but bait hanging in front of desperate traders. I am not here to reteach you Japanese candlesticks or Fibonacci tools. I assume you already know them, and I assume they have not made you wealthy. I am here to give you what you actually need, the 3 core filtering rules, the razor-thin line between the hunter and the hunted. These rules are not theory. They were distilled from blood, from thousands of hours watching smart money move, from observing how high-frequency trading tears through sensitive zones. They are your shield against becoming liquidity and your spear for riding the institutional wave. If an order block does not meet these 3 rules, it does not exist to me, no matter how perfect it looks. Are you ready to abandon the victim mindset? Ready to stop paying tuition to the market and start collecting tuition from those who come after you? What I'm about to tell you will shatter beliefs you have held tightly. It may make you uncomfortable, but when you apply it and see the unnerving accuracy, you will finally understand why I say, if you do not know who the prey is at the poker table, it is you. Step into the world of smart money, where every candle is an act of manipulation, and every order block must survive a ruthless examination before it earns a place in our trading plan. We have built the stage, we have stripped away the innocence, and now we stand exactly where profit is measured by the amount of liquidity you extract from someone else's hands. If you are clear-headed enough to stand here, then it is time to learn how to operate the core filter, the tool that will completely redefine the way you read a chart. Knowing that an order block exists means nothing. Knowing whether it contains the manipulation intent of smart money is what actually matters. That is the difference between seeing a fish and reading its path through the water. Rule number 1, filter through the footprint of a liquidity sweep. An order block is not a starting point. It is a destination. Every major price displacement shares the same initial objective, liquidity. If smart money has not collected enough liquidity, it will never commit large capital. So forget the clean order blocks resting neatly on support lines. Those are bait. A legitimate order block only forms after price has aggressively broken through an area the crowd believes is important, usually equal highs or equal lows. Whenever you see 2 equal highs or 2 equal lows, you are staring at a flashing neon sign that says, the money is here. Above equal highs sit buy stop orders. Beneath equal lows sit sell stop orders. Concentrated, obvious, easy to harvest. The essence is deliberate deception. A valid order block must be born after price pretends to move in one direction, hooks retail traders, sweeps their liquidity, and only then produces the real reversal. Without a liquidity sweep, if it is simply a mild bounce within a trend, that is not an order block. It is just a random price level that will collapse the moment real liquidity pressure arrives. A true liquidity sweep is not just a stop-loss tap. It is one or several violent candles that pierce directly through a liquidity pocket, trigger a wave of market orders, and immediately reverse. The candle, or cluster of candles, right after that reversal is the genuine order block. It is the clear signature that smart money has accumulated enough orders to pivot the market. The remaining price area becomes an unfilled pocket, the void the market must return to fill. Rule number 2, filter by power signature, imbalance and fair value gap. The first rule gives you intent. The second gives you strength. A valid order block is always created by an explosive price displacement powerful enough that the market cannot rebalance immediately. That imbalance is the fair value gap, the inefficiency that every professional trader hunts. If an order block is created by a balanced candle with no gap between the preceding and the following candle, it is weak. It is filled immediately. It carries no evidence of institutional force. In contrast, a fair value gap is the scar of smart money, the imprint of massive orders executed in seconds. And because the market always seeks equilibrium, fair value gaps become magnetic zones. The order block that forms directly before or within a fair value gap becomes a fortress of liquidity. Here is the brutal equation. Liquidity sweep plus fair value gap equals high-quality order block. When those two conditions align, the order block is no longer just a price zone. It is a stronghold. Price must return. Price must fill the fair value gap. And when it taps the order block, that is where institutions re-inject capital. An order block without a fair value gap is a well-tailored suit with nothing inside it. Attractive, but useless. Discard it. Rule number 3, filter by time. The time of day principle. Smart money does not trade randomly. Everything operates on a liquidity schedule. No fund in New York enters a major position at 3 o'clock in the morning. Algorithms are programmed the same way. They act with maximum aggression only when the market is crowded with liquidity. The reason is simple. Hide order size and minimize slippage. So we trade during the kill zones, London Open, 2 o'clock to 5 o'clock a.m. Eastern Standard Time. New York Open, 8 o'clock to 10 o'clock a.m. Eastern Standard Time. These are the hours when volume spikes and money churns violently. If your order block forms outside these zones, especially during the quiet Asian session, it is almost always noise. There is no significant capital commitment behind it. Question everything that forms outside the kill zones. The core filter is built on 3 pillars: liquidity sweep, fair value gap, kill zone. If all 3 conditions are present, the order block deserves your attention. Everything else? Discard. The art of execution, the midpoint rule, the optimal price hunt. You have identified a perfect order block. Price is returning. And this is when retail traders make their timeless mistake, placing a limit order at the edge of the order block. They believe they are being clever. They forget the market is designed to make them look foolish. When price taps the order block, the entire crowd's orders pile up at the boundary. What does price do? It pierces through. It triggers a secondary liquidity sweep. It clears stop losses of those who entered too early. Only then does it reverse. Professionals never enter at the edge. They enter at the optimal zone, the midpoint. The method. Mark the full range of the order block. Identify the exact 50% level. That is the discount zone for buy trades and the premium zone for sell trades. That level is the optimal trade entry. Why 50%? Because it represents the lowest risk zone and the point where institutions want to complete the remaining portion of their large orders. If we are buying, we want the best possible price. If we are selling, we want the highest possible price. The midpoint of the order block is the perfect equilibrium for institutional execution. Waiting for price to reach that level means you avoid shallow stabs and half-hearted reactions. The traps that wipe retail traders out like dry grass. The predator mindset. Patience is profit. High-level trading is not a sprint. It is a discipline of patience. Once you have an order block that satisfies the 3 rules, your job is not to enter. Your job is to wait. Wait for the return. Wait for the secondary manipulation. Wait for the midpoint. Retail traders act out of fear. They click buttons out of anxiety. But you are not them. You are a predator. And a predator does not chase everything that moves. It strikes only when the prey steps into the exact kill zone. You need only one perfect trade, one precise target, one well-timed entry. The discipline to ignore 9 out of 10 trash signals is what builds massive profitability, not the frantic button pushing of adrenaline addicts. Remember this, your job is not to predict. Your job is to read the intent of the liquidity holders and move with them. When you master the 3 core rules and execute at the midpoint, you are no longer trading supply and demand. You are trading liquidity manipulation. You have stepped out of the role of prey and into the role of the hunter. That is when you stop paying tuition. And you begin collecting profit. Now open your chart, remove the noise, and look at the market through the eyes of smart money. If you have truly internalized the 3 core filtering rules, you have already moved farther than the vast majority of the 95% drifting outside. You are no longer looking at the chart with the naive eyes of someone trying to catch a falling knife. You are looking with the cold eyes of an investigator, scanning every trace of the crime left behind by the sharks. But merely filtering out a perfect order block is not enough to make money consistently. You must know how to place it inside the broader strategic landscape, the framework professionals call liquidity cycle reading. The difference between an amateur thief and a true strategist has never been about lockpicking skill. It lies in the ability to understand the entire operation, to grasp the final objective of the mission, and to know the exit route before stepping inside. In this market, the final objective of every price movement is summarized in one word: liquidity. The higher time frame is the law. The lower time frame is merely the case detail. Before you touch any order block or fair value gap on the 1 minute or 5 minute chart, you must understand one thing. The daily chart, the 4-hour chart, and the weekly chart are where the rules of market behavior are written. Retail traders are trapped inside lower time frames, chasing every small twitch like a dog tied to a pole barking at bird shadows. We trade the daily, the 4-hour, and the weekly charts, the places where real institutional blocks leave footprints. Every decision revolves around higher time frame structure, around the places where real money is committed or withdrawn. You must identify the order flow of the higher time frame first. There is no exception. A break of structure is confirmation that the flow of capital remains loyal to the current direction. A change of character is the cold warning that the trend may be preparing to pivot. And when the 4-hour chart is printing a bullish break of structure, every order block on the 15-minute chart has only one role: demand. Do not try to look for supply inside a strongly bullish environment. That is how you commit suicide with a limit order. A professional trader never asks, "Where should I enter?" He asks the far more important question: where are the sharks trying to take liquidity? That is the draw on liquidity. And the draw on liquidity always resides in untouched liquidity pools, prior highs and lows, external liquidity from the previous week and month, or large fair value gaps on the daily and weekly charts that have not been filled. Once you combine a valid order block with the order flow of the higher time frame and a clear liquidity objective ahead, you are operating with institutional grade probability. The order block is the launch point. The draw on liquidity is the landing zone. If there is an untouched equal high sitting right above your order block, be cautious. The sharks may use that very order block as leverage to spring upward, sweep the liquidity, and only then deliver the true reversal. The liquidity cycle always operates with a brutal logic: sweep, order block, formation, expansion into the draw on liquidity. Retail traders treat risk as an enemy. We treat it as the unit of measurement for the game. 1R is the amount you are willing to lose. Our objective is never a handful of pips. It is 3R, 5R, 7R. At those ratios, a win rate of 35% is enough to be profitable. Our rules do not require a perfect win rate. They require a mathematical edge. And the stop loss is never placed out of fear. It is placed where the trade idea becomes invalid. If the market hits the stop loss, it is not proof that you were wrong. It is proof that the higher time frame order flow has shifted. Cut the loss cold. No regret. Retail traders are addicted to confirmation. They wait for the 1-minute chart to flash a change of character before they dare to enter. And by waiting, they forfeit the best position, skipping the strongest reaction that occurs directly at the valid order block. They turn a 1-to-5 trade into a 1-to-1 because of fear. This psychology is the reason they lose. A professional trader applies set it and forget it. Filter the order block. Place the order at the exact 50% midpoint. Set the stop loss in perfect structural alignment. Then close the chart. No revisiting, no adjusting the stop loss, no interference. And when an order block fails, retail traders call it a personal failure. We call it data. A valid order block being violated reveals new liquidity, a new flow of capital, and the emergence of a new opposing order block. We reverse immediately. You must become as cold as a machine. The market has no emotion. It cares only about liquidity. A stop loss is not an insult. It is a message from the market. Your job is to read the message, not react emotionally to it. Once you understand the liquidity cycle, the 3 core filtering rules, R multiples, and the set it and forget it philosophy, the final enemy appears: yourself. Retail traders measure results daily. Professionals measure by the quarter, by the year. For us, a 3R trade is revenue. A 1R loss is an operational expense. The most expensive cost is revenge trading, premature profit taking, and overtrading. Those will destroy an account faster than any stop loss. Remember the casino. The house does not care if a player wins tonight. The house has a statistical edge. So do you. The 3 core rules are an edge. Our multiples are an edge. And your job is to eliminate emotion to protect that edge. Drawdown is not a disaster. It is a test of your faith in the system. Reduce risk during drawdown. Keep the rules intact. Do not allow a normal losing streak within the statistical model to destroy your discipline. Survive long enough, and the edge will return everything to you. The final secret of Wall Street is not in any pattern. It is in removing the human element at the moment of execution. Set, execute, forget. No negotiation, no hope, no regret. You let the stop loss or the take profit determine the outcome. Emotional fluctuation is the trademark of retail traders. Market makers do only one thing: execute the logic. Now you hold the full blueprint of the game, from how the market is manipulated through liquidity to how to select valid order blocks, how to read order flow, how to maintain your edge, and how to protect the alpha mindset. The market does not care about hope or dreams. It responds only to capital. And now you know where the capital is flowing. Stop trading like retail. Start trading like a market maker. We've walked through everything. You've shed the fragile skin of a retail trader and put on the armor of a market maker. The market is no longer a place for you to hope. It's a hunting machine, a liquidity manipulation engine designed to crush anyone who doesn't understand the rules. You've mastered the triple filter rules. You know R multiples aren't knowledge but commands. And you can read the heartbeat of order flow on the higher time frames, where real money moves and real intentions are written. At this stage, you're no longer looking for a setup. Setups are for beginners. You're looking for an execution scenario, a logical chain confirmed step by step, emotionless, like a miniature version of the liquidity algorithm the sharks operate. A pilot never takes off if even one item on the checklist is missing. A market maker is no different. The difference between getting paid and getting crushed isn't emotion, it's checklist discipline. Your entire system must operate like a mechanical approval process. No guessing, no hoping, only confirm or deny. And you're only allowed to place a limit order if, and only if, every answer is yes. Start with the higher time frame. Is the H4 or D1 order flow bullish or bearish? If H4 is bullish, the only thing you're allowed to look for is demand. Trading against higher time frame flow is suicide. Retail trades what they like. Market makers trade what the money flow allows. Next, has liquidity been taken? You must see an equal high or equal low swept before an OB forms. No sweep means no inducement. No inducement means no manipulation intent. An OB is not a decorative box on the chart. It's the fingerprint of whoever just harvested the crowd's liquidity. Then, your OB must leave behind an FVG. An OB without an FVG is a gun without recoil. No displacement, no commitment. Imbalance is the testimony of real money, the confession smart money leaves after they strike. Then you check kill zone. If the OB doesn't appear or isn't retested during London Open or New York Open, it's not where big money activates. No liquidity, no process. Flow only moves when the global capital centers open. Outside of that, everything is noise. Your entry must be at OTE, the 50% midpoint or deeper. Why? Because that's where price returns to collect liquidity before it moves. That's where amateurs are flushed out and where you're boarded onto the move. Finally, RR must be at least 1-3. If the scenario cannot give you 3R, you don't trade it. You don't exchange 1 unit of risk for 1 or 2 units of reward. You don't work for break even. You trade for statistical dominance. And if any condition is a no, you step aside. You do not click. You do not argue with the market. You do not trade out of boredom. This system only works if you follow it like a general obeys battlefield protocol. 1 trade is enough. Retail believes the number of trades proves effort. They think more clicks equals more money. That's why they die on M1. You're different. You understand quality beats quantity. 1 5R trade can pay for an entire month of errors. 5 to 10 trades a month is more than enough to live well. Once the order is set, limit SLTP, you walk away. No watching, no praying, no interference. Professional profit doesn't come from action. It comes from inaction. The 2 demons that blow up accounts fastest are fear and hope. The moment you watch a running trade, you feed both. You must trade like a sniper. Pick 1 perfect target, just 1. Then wait. No following noise, no spraying bullets. Becoming a market maker means embracing solitude. You'll see the whole world talking about RSI, trend lines, triangles, engulfing candles. They'll laugh when you place an order inside an empty FVG. They'll call liquidity sweeps a glitch. They don't understand because they don't see what you see. They trade the chart after the fact. You trade the intention behind the money. This system will not eliminate drawdown, but it will ensure you always stand on the side of probability. A 1R loss is just a cost. A 3 to 5R win shapes your entire equity curve. You're not fighting per trade, you're fighting through long-term edge. Now close the document, open your chart, and don't look for pretty patterns the internet taught you. Look for manipulation footprints. See the OB as your firing position. See crowd liquidity as your target. Use your checklist as your substitute brain. The market is ready. The crowd's liquidity is already on the table. It's your turn to step in and take your share. If this video helped you see the market more clearly, drop a comment below. And don't forget to like, subscribe to Trading Mindset Lab, and turn on notifications so you never miss the next lessons.